Welcome everyone. Welcome to this episode of Market Wrap. I have with me Mr. Pankaj Pandey and lots to unwrap in this episode. Sir, बहुत सारी अच्छी good news आई इस week. We had Trump saying कि no more tariffs at least for 30 next 30 days. Then we had RBI policy outcome as well, which was also positive in a sense. And yet the market, while it gave a 1,000 point rally in the 10 days, but then again it didn't kind of breach that 23,800 barrier. What happened there?
Hi, good evening, Vishu. Yes, you're right. Markets did extend some gain this week, so we ended marginally positive. And this is despite the fact that global cues were positive because of the tariff pause by Trump. Then you had RBI policy outcome. I think what we have all have been waiting for quite some time is the kind of a short covering. It happened in bits and pieces. So overall, the short covering is yet to sort of happen. While from the lower levels, Nifty has definitely seen a 4% kind of a bounce back. But somewhere down the line, there are still shorts in the system because of the anticipated anxieties. So our sense is unless if the market sustains 23,300 kind of a levels for next week, then a possible attempt towards 24,200 could be made. In case if it fails, then again we might be hitting towards the Jan lows. So we are still not out of the woods because the FI shorts are still there. The global anxieties are still persisting. But having said that, there's some positives which have come out, especially from a US perspective. One is your dollar index is not breaching or breaking beyond 110 kind of a levels. Crude has been soft. And so from that perspective, things have been good. And hopefully, if things turn better because Modi PM is visiting US next week, so somewhere down the line, our sense is that there could be some positive development there. But having said that, yes, we've seen a bit of a short covering move, but the FPI selling continues. And typically in all your big banks, and which is why if your Nifty is not performing, and on top of it, IT is also not doing much, then very little chance for Nifty to sort of bounce back. The broader markets have done relatively better. But yes, I think things are still in a wait and watch mode.
Right. So could we delve into the RBI move a little deeper and analyze its impacts?
Oh yes, so RBI definitely met the expectation on the rate card. But when you look at the market reaction was not so great. Largely because see two things. One, when RBI is done, this kind of a rate cut, which is what was the expected. I think there were two, three things which were not really liked by the markets. One, obviously, that RBI did not change the stance. So we are still maintaining a neutral stance. So giving a fear to the market that this rate cut cycle is will not have much legs. The other thing is that while the cost of liquidity is going down, but liquidity itself is not being offered higher. So which is where I think so rate cut करने का फायदा तब होगा when you see the transmission also happening. And when liquidity itself is going to be tighter, so then transmission is not going to happen, and which is where I think the disappointment came. Another factor for disappointment was that, see, earlier, if you look at quarter one and quarter two of FY26, RBI was predicting a growth rate of 6.9% and 7.3%. They have sort of brought it down to say 6.7 to 7%. So somewhere down the line, RBI is also not looking to sort of go aggressive in terms of growth. So that is also another thing which probably weighed the sentiments on the market. But overall, yes, it's a good beginning. Let's hope that the liquidity situation becomes better. Ideally, it should become better from April onwards. Till March, it is expected to remain tight.
Absolutely. Sir, we saw a number of results also out from the big boys as well. Let's start with SBI. I think that was a complex one to crack this time.
So one is the people should not look at the kind of a hefty profit jump because those that is an optical number. Typically, profit numbers for banks do not matter much relatively. You need to look at other parameters. So coming to those parameters, one is on the overall advances growth. It was quite steady at 13.5%. Deposit growth was lesser at about 10 odd percent. Now, asset quality, no issues. We are seeing sequential decline in the overall gross NPAs. Credit cost has been sort of maintained. What was not really liked by the market, or what was the only missing piece, was that there was an expectation that the NIMs or net interest margins will decline by 3 to 4 bips. The decline was about 13 bips. And because obviously you are raising deposits at a higher cost, and which is what everyone has been wanting from RBI to sort of ease up the liquidity. So it does not really change much from that perspective. So that is the only thing which was missing in the SBI number. Overall guidance for next year is also okay. Advance growth of 14 to 16 odd percent, deposit growth 10%, ROA 1%. We marginally tweaked down our targets to about 910. Earlier, we used to carry a target of 1,000. But still maintaining a buy because absolutely no issues. It is a temporary challenge in terms of deposit cost being higher, and consequently, its impact on the margins.
Absolutely, sir. We also saw results from Mahindra and Mahindra, the owner of, let's say, B6 now instead of B6E. How were the numbers, sir?
So before I come to that, a bit of this thing on the auto volumes as well. So obviously, I think this is definitely a good beginning for auto number. The volume growth was pretty good for two-wheelers and four-wheelers. CV was flat. Now coming to two-wheelers, I think Aisha did very well with a 20% kind of a growth. TVS 17.5% growth. I think TVS continues to do very well across. Bajaj just has seen a good growth in the export volumes. So overall growth was 6.5%. Now on the PV side, M&M continues to do very well. I mean, 17.5% kind of a growth. Their numbers have jumped up to more than 50,000 units a month. Compared to that, the other segment players are struggling. So Tata Motors flattish. Hyundai was marginally down. CV, like I said, was flattish. So from that perspective, no major changes in the CV side. I think tractor has started to sort of see a turnaround. So especially M&M witnessed a growth of about 15 odd percent. So M&M continues to do very well, be it segments like say tractor or the utility vehicle. Now coming to numbers, they've been delivering double-digit growth for quite some time. And accordingly, revenues were up 21%. So again, you had a 16% growth in the on the automotive side and about say 20% growth on the tractor side. Margin profile has also edged up in both the segments. They've been sort of gaining market share in the tractor segment, especially on a quarter-on-quarter basis. If we look at, and like you said, they've been at the forefront of new launches. So that is obviously going to help them. So I think M&M continues to do very well within the auto pack, sort of an outlier, which is why it is a top pick with a target price of 3,600.
Great, sir. While we're talking about cars and automobiles, let's talk about tires as well. JK Tires result was out. Apollo Tires reported, MRF reported their numbers. What happened there?
So in tire companies, you see similarities. The rubber prices have gone up, so which is why you look at on a YTD basis, all the players have seen their gross margin compression of about 500 to 600 bips. Now, while they have tried to maintain, and which is why when you look at their EBITDA margins are down about 300 odd bips. So that has been the case for most of the players. Apollo Tire within that did relatively better. So their decline was about only 100 odd bips. Now, good part is that most of the players are hinting that the margin decline has bottomed out and is expected from, say, Q1 of FY26. So I think last 2-3 quarters, they've been seeing margin decline, and Q1 onwards, things are expected to sort of improve, especially on the margin front. And like I said, overall CV volumes can also pick up because one, the overall sense is that the economic activity should pick up like the subdued activity, what we have seen. So that should help CVs and again, tire segment or tire companies derive a good chunk of their revenues from truck tires or bus tires. So from that perspective, things are turning to be slightly better for tire companies.
Right, sir. Sir, ITC also came up with results, and that was not the only reason it was in highlights this week. We also got ITC hotels listed. So how does it look like for ITC?
So ITC, again, compared to expectation, things have been different. So in cigarette, the expectation was that you will see a 3 to 4% volume growth. The volume growth was 6%. In FMCG, the expectation was that the volume growth is going to be 6 to 7 odd percent. The FMCG business witnessed a growth of 4%. Like all the players, I think the challenge has been on the urban side for most of the companies. But when you look at from the budget perspective, 1 lakh crore is the kind of a tax benefit has been given to the middle class. On top of it, a lot of state-run schemes are being run. So the overall sense is that the rural market will keep on doing better compared to the urban market, 2x the kind of a growth. So that should sort of improve the overall growth prospects. Now, coming specifically in this particular quarter, there was a margin pressure of about 240 odd bips for ITC because in a segment like say FMCG, some of the input prices like say for example palm oil, so those have gone up by 25-30 odd percent. So those have impacted the margins. So from that perspective, numbers were okayish, I would say. Inflation, cost inflation is impacting the margins. But overall sense is that this is something again transitory in nature. ITC compared to other FMCG companies trades at a relatively attractive multiples of say 22 times FY 27. So that way it's good. I think hotel business continues to sort of do well. So we have a fair value of about 195 on the stock. So I think hospitality is one segment which continues to do well. I mean, be it for Indian hotels or be it for other players. So I think that is one business which continues to do well. Mind you, these numbers are without the ITC hotel business.
Right, sir. Sir, Trent is also one stock which has been which has confused the investors a lot. I think it has been delivering performance better and better every week on week, month on month, year on year. But its stock prices has tumbled quite a bit. How did the numbers look like this time?
Oh, yes. So from the highs, I think the stock has corrected about 35-37 odd percent. Now, this is one company which continues to sort of deliver pretty healthy growth rate. Even this quarter, growth rate was good. Top line grew by 37%. Bottom line also similar. EBITDA growth was about 34-35 odd percent. Now, if everything is so good, then what is the missing piece? So when you look at the missing piece is that the like-to-like sales growth up till Q2 has been about double digits, about 11-12 odd percent. In this quarter, it came down to 9 odd percent. And mind you, this is one of the few stocks which is literally priced for perfection. I mean, you look at this is one stock post correction also, it's available at about 36-37 times EV by EBITDA of FY27. So within the consumption-oriented stocks, this was one of the stock which was doing very well, and again has. So when you're sort of priced for perfection, you can't be missing on any of the parameters, which is what this company sort of did. But nevertheless, we continue to like this company because he understands that Indians are quite price conscious. So this is the only company which is operating the value fashion business, doing very well. So any kind of a further incremental weakness, I think, should be used as a buying opportunity because I think a lot of players have started to sort of copy their models, but I think the kind of growth they have been delivering is quite sort of unparalleled. So from that perspective, good company, slightly difficult times or a bit difficult times.
Absolutely, sir. How about Bharti Airtel, sir? Its numbers were also out.
Good set of numbers because typically Bharti you compare with Jio, Voda has its own set of challenges. Jio has seen a ARPU growth of about 4 odd percent. Compared to that, Bharti did about 5%. So accordingly, your revenues have also gone up by closer to 6 odd percent. They've started adding subscribers on the 4G and 5G. So that is also a better thing. And overall sense is that the numbers have been quite good. So you had seen margins also being better on the domestic side. Africa business also has been sort of doing well with a 5% kind of a growth rate. I think the key thing to watch out for would be that in the last 4-5 years, the earlier price hike was about 25%. And every price hike happens in a block of 2 years. And then we have 15%. And overall sense is that next hike could be in the range of about 10 odd percent. And that is when it is going to sort of throw a lot of cash. But while the numbers are good, I think the one of the worry is if Elon Musk company Starlink sort of comes to the country, the kind of disturbance it is going to create to the overall telecom ecosystem. I think that is where the market is still sort of divided, which is why despite good results, you are not really seeing this pricing or this stock price is doing very well. I think there's a bit of uncertainty there. But in general, this is one of the best plays to play in the telecom side. They are the most efficient ones. Absolutely no complaints from the number perspective.
Right, sir. How about NCC?
Oh, yes. So a lot of companies have been the casualty of the massive election cycle which we have seen last year. And NCC was one of them which got impacted. So while top line, there was a degrowth of 1.5%. But when you look at the bottom line and EBITDA, the decline was about 15 to 13 odd percent. And more than that, the stock took a significant beating. Now, again, the reason is that when the election happens, the billing cycles get elongated. So rather than sort of keeping or trying to sort of keep on executing, the company preferred not to sort of execute more because eventually that leads to again higher debt levels or working capital. So while their debt or working capital has definitely gone up, but they chose not to sort of execute more. So obviously that impacted the numbers. Otherwise, no major challenges. So margins were down for the company. So this year is likely to be a sort of a washout because see, this company was guiding for a 15% kind of a growth rate, and with election-led delays and elongated billing cycles, overall sense is that again you will see a 5% kind of a growth rate, and things will normalize, say from the Q1 of FY26. So again, Q4 is again expected to be another muted quarter. So I think that is why the market reaction was negative, and rightly so. Also, our sense is that unless things ordering does not pick up or the money does not start to sort of flow in, a lot of these players will sort of struggle for some time. Not to say that business models have got impacted, but it's a temporary challenge what you're seeing in the business because of elections.
Right, sir. Sir, going back to the budget for a small bit, I think defense was the only capex sector which actually saw growth. One of the very few sectors. So, how did the results come out for defense sector in general?
So defense could be in limelight because of the PM's visit. So it remains to be seen. But when you look at specific to numbers, again, this is a sort of a mixed quarter. Again, Bharat Dynamics did well, 38% growth, but first half was muted. Solar Industries, which supplies say, explosive to Coal India and other players for stripping out coal. Since the coal volumes or in general domestic, there was a slowdown. So that company, while it reported a good 38% growth, but they are still sort of expecting some softness going forward. So stock also witnessed some bit of a reaction. Cochin Shipyard again witnessed a moderated revenue growth. Midhani again 6% kind of a degrowth. Data patterns again 16% kind of a degrowth, largely because of the deferment of the scheduled delivery. So in defense, a lot of things need to go right for delivery to happen. Otherwise, you might make a component, but if your, for example, Tejas is not ready, then your components will not really go, and which is why some of the companies have got impacted. Tejas is just an example, not to say that all these companies got impacted by it. So hopefully, I think defense will gain momentum once Modi visits US. Let's see. I'm keeping my fingers crossed.
Absolutely, sir. Sir, finally coming to the most awaited segment of the week, which is hidden gem. Which will it be this time?
So I'm playing safe. I think a lot of market segments have got impacted in the recent past, and which is why I think consumption is something which is looking relatively better. So I'm recommending a company called Allied Blenders and Distillers with a target price of 495. Now, this is a company which is the third largest player in the Indian-made foreign liquor in terms of sales. They've got about 17 brands. Officer Choices, they're one of their biggest brands, and it is the third largest whiskey brand. Now, the story for this company is like that the overall top line growth is going to be in high single digits. So about 9% kind of a growth is what we're seeing. But when you look at the premiumization or the prestige and above segment, so that segment has been gaining traction. So it used to be about 25%, 2018, now it's 37%. 2 years down the line, we would expect this to be about 50 odd percent. And what it does is that it improves the margin profile. So margin profile from say 6, 7 odd percent could improve to 13%. And as a result of that, you'll see about 30% kind of a growth in the EBITDA over the next 2, 3 years. Bottom line again, it used to be single digits in FY24. This year we are expecting about 161 odd crores, and next 2 years we are expecting it to cross 300 plus crores. So the kind of re-rating we have seen for a stock like, say, for example, I'm sort of forgetting the name. Uh, 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 so from that perspective, overall sense is that the premiumization leg is going to drive the margins and profits, which is why we're liking this company. And relatively, this company should not be impacted from the current volatility what we're seeing in the markets.
Absolutely, sir. Well, that was our time this time, but we'll be back next week with another wrap. In the meantime, if you have any comments or questions, please put them down. We'll try to get back to you. Thank you so much once again, Pankaj sir, for your time and insights.
Thank you.
Investment in securities market are subject to market risk. Read all the related documents carefully before investing.